It's June of 2025 and it's officially a crazy market. So let me just walk you through a few different things with interest rates and home prices and a couple of forecasts. I'm getting a lot of questions about what's likely to happen with rates and home prices, and I do have an opinion on that and I want to share it with you. So first off, let me start with a quote from Lawrence Yun. Lawrence is one of my favorite economists. He worked for the National Association of Realtors, and he says, are we going to go back to 4% interest rates? Per my forecast, we're not. It's more likely we'll go back to 6%, and the new normal will be somewhere between 5.5% and 6.5%. Now, I combined a few different forecasts. There's lots of places that do it, but these three I like to follow pretty closely is Fannie Mae, the Mortgage Banking Association, and Wells Fargo economists. So those three put out a quarterly estimate of what they think mortgage rates are going to be. And so by the end of this year, Fannie Mae's forecasting 6.1, 6.6 for MBA, Wells Fargo at 6.3. Well, mortgage rates currently are 6.89%. And to put that into perspective, at the beginning of the year, we were up here at 7%, 7.04. And since then, it's been below 7%, but kind of hovering around the 7% range for throughout this year. It's been as low as 6.62 back in April. But with 6.89 rates, if we're at 6.1 or 6.3 by the end of the year, that'll be pretty good. For looking forward a little bit further, if as you move into 2026, you can see everybody's forecasts are lower, not a whole lot lower, but a little bit. You can see from 6 to 5.9 to 5.8 by the end of the year. So the consensus is that we're probably going to be seeing rates lower, at least slightly, within the next year and a half. Freddie Mac always comes out with a nice little snippet, and they said lower mortgage rates should be boosting the housing market, but it's going to be modest because a lot of buyers are staying on the sidelines expecting further rate declines. And I'm seeing a lot of that where people will come in and get pre-qualified and then they just don't move forward with their home purchase right away because of the high rates. And really a big part of it comes down to, can people afford a home? If they can't, then it's really hard for the housing market to continue to go up. And so the National Association of Realtors comes out with this thing that says, it's called the Housing Affordability Index. And it's kind of a composite of median home prices and median household income of how much people are making, and then what interest rates are and what that factors into a monthly payment. So on this chart, you can kind of see the 100 line going right here through the middle. And 100 would mean the median household income is 100% of what is needed to qualify for a median house at today's interest rates. So anything above 100 means it's affordable. Anything under 100 means the average person can't afford a house. And you can see there's only twice in history that it has dipped below 100, and one of those was last year. Well, 23 and 24. We were at 96.9 and 98.8, meaning the average person doesn't quite make enough to qualify for the average house, which is kind of crazy because 2012, 13, 14, we almost hit 200 on that number. And I remember doing the math thinking, okay, two people working at Taco Bell could easily qualify for a house right now for our average price house. But since then, home prices have gone up, interest rates have fluctuated. And so far this year, we're at 103, meaning that we're back into affordable territory, but not that affordable. At 103, it's just like people are squeaking into houses. Now, it's really important to know, though, that these are nationwide numbers and real estate is very local. So it can vary drastically by markets. And I just looked up three. I can look up any market in the country and see. So if you're curious and you want to see somewhere else, just reach out to me. I'm happy to run this anytime for you. But here in Yuma, in my local market, 56,901 is our median household income. So it's lower than the national average, but our home prices are also lower than the national average, which means our affordability number is 115, which makes it one of the most affordable markets in the country. Not the top, but definitely better than a lot of places. If you look at Maricopa County in the Phoenix area, 84. Pima County over in the Tucson area, 93. Both of those below 100. So what are home prices likely to do? Now, I didn't make this chart. I found it, but I think it's interesting that, I mean, there's everybody and their dog wants to forecast what home prices are going to do. We have 19 different economists here that have weighed in on this. If you average them all, 3.1% is the average or the estimated appreciation rate for 2025. So there's only one that's in the negative, is Moody's, is minus 0.4. So home prices they think they'll go down, but 0.4 is not that much, pretty much flat. Anyway, why are home prices continuing to go up when interest rates are so high right now? Part of that is just demographics. This is a chart that shows you how many babies were born each year in the US. If you say the average home buyer is 33 years old, then people that are home buyer age, that would mean what? 2025 minus 33, 1992. So in 1992, we need to move this arrow over a little bit, but we're right over here. You could see that there's not as many babies that were born in those years, and it's starting to come up, but there just weren't. For the past decade or so, we've just been in this little trough where there's not as many people born. And as this is starting to increase, well, now we have more home buyers coming into the market. The other side of that, and this kind of takes, the blue is kind of the same as the babies being born, but it's household formations, which anytime there's a kid that moves out of their parents' house, or a divorce where it used to be one household and now you need two houses to house the same people, that's a household formation. And then the orange is completions, which is new construction of housing units. So whenever the blue is bigger than the orange, that means that year there's more people or more households were created than there were houses built to house them. And you can see it's been like 15 years where the blue has been bigger than the orange. And because of that, we really have a housing shortage where there's more households being created, not enough houses being built. I heard an estimate that said we're about 2.4 million houses short of where we need to be to meet the current demand. Here in Yuma, in our local market, the average sales price, if you look at compare 24 to 23, this black line here shows you that the price went from 271 to 298. That's about 9.5% increase in that 1 year. And then the blue line is single family homes, and just looking at the last year, 311 to 335, that's about 7.5% appreciation rate for the last year. That's higher than the national average. Now, it's not always just a straight line up. This is a monthly view of it, and you can see month by month for the last few years, there's these little ups and downs. So it's possible you might have bought a house at a peak month and that the price might be lower. But overall, this doesn't look like a crashing housing market. This looks like kind of a sloppy top to the housing market. It's not going up, it's not going down, it's pretty flat. But overall, it's actually still going up. The flip side of that is how many houses are being sold. And if you look at 2021, we peaked out selling 3,691 units in Yuma. And since then, we have 3 years of it going down. And the same kind of thing happened back in 2006, 2007, 2008. This is when the housing market kind of crashed. And before that crash, we had peaked out at 1,800 units. We had 4 years in a row of selling fewer homes, and then the market picked back up, and we never saw another decline until 2022. It'll be interesting to see what happens there. If you look at that on a monthly basis, really, I mean, I'm looking for some kind of trend, and I just don't really see it here. It's up and down, but there's not really an overall dropping or raising. So zooming those two things out a little bit further, this goes back to 2018. So what's that, like 7-8 years of data now that we have. And you can see it doesn't look like the market's crashing at all. 2024, we definitely saw a decrease in the number of homes sold, but it's kind of picked right back up when you look at it from that perspective. A couple other housing stats that I think are super interesting to watch is price reductions and seller concessions. So this top left where it says percentage of sales with price reductions, that means somebody tried to sell their house, they put it on the market, it didn't sell, so they reduced the price before they finally got it sold. Well, if you look at national headlines in a lot of markets, there's huge amounts of price reductions happening, and they're happening here too, but in May, it was about 20% of homes had to have a price reduction before they sold. That's not a huge number. It's definitely been higher. Even this just goes back to 2018. The other side of that is seller concessions, which is where the seller is paying closing costs on behalf of the buyer. And that is definitely up. In May, 75% of all the sales that happened in our local market had seller concessions of some kind. Now, it doesn't tell you how much was on each of those, but 75% contains some kind of seller concessions, which is a big number. Days on market is another one. I like to watch this kind of closely just to see, okay, if the days on market are skyrocketing, that just means from the day you list your house to the day it sells and transfers to the other person, how many days did it take? Right now it's about 198 or something like that, but about 100 days, which is up over the last couple of years, but it's not an exorbitant number. Okay. One thing that we're seeing a lot of buyers interested in and some taking advantage of is a 2-1 temporary buy down. So by doing this strategy, you could take and get a 4.99 interest rate for the first year. So if the going rate is about 7% right now, or 6.99 on a $400,000 loan, it's going to cost you about $9,300 to buy down your interest rate to 4.99 for the first year and 5.99 for the second year. Now, if you just took $9,000 and offered $9,000 less on the price, it's possible that you would get it. $9,000 on $400 is what, about 2%, a little over 2%. Well, coming back to this one, the list sold ratio right now is about 99%. So homes are selling for 1 to 2% under asking price anyway. So you might be able to get the seller to take $10,000 less for the house. That will save you maybe $60 or $70 a month to take it off the price of the house. Whereas if you take it here in concessions and apply it towards a temporary buy down, it's going to save you $513 a month for the first year, $262 a month for the second year. It's a great strategy for cash flow. It helps to keep your monthly payment low for the first couple of years of ownership. It's also great for rental properties. If you're buying an investment property, you could do a temporary buy down that just really increases your cash flow for the first couple of years. And if those interest rate predictions are correct, there's a good chance we'll be refinancing to a permanently lower rate at the end of that term anyway. So that's a strategy to keep in mind. One other thing to keep in mind is that a lot of homeowners have a lot of home equity. This chart shows you that in the US, there's about $13 trillion of mortgage debt out there, and there's about $35 trillion of home equity. And so if you're in your home and you have any kind of other debt that's at a higher interest rate, even though a mortgage rate might be 6 or 7%, if you're carrying any kind of credit card debt, it's probably at 20 or 30% interest. And so tapping into that home equity to pay off lower or higher interest debt in some cases really makes a lot of sense and will save you a lot of money on your monthly budget. So, all right, that's all I have for you right now. I hope you have a great month.